In this presentation, we're going to add an owner withdrawal with the use of bank feeds. In other words, we're going to see the money coming out of the checking account with the use of the bank feeds, and our job is then to allocate that to the financial statements. Time to turn the page with Sage Business Cloud Accounting. Here we are in our Get Great Guitar Company summary page within Sage. We're going to be opening up our financials here by going to the reporting dropdown and opening up that balance sheet. Once open, we're going to be duplicating the tab, as has been our practice, by mousing over that tab up top, right-clicking on it, and duplicating it. We're then going to go back to the tab to the left. We're going to do the same process with the P&L profit and loss. And then we're going to go down to that P&L profit and loss, otherwise known as the income statement. We're going to go back up top and mouse over the tab up there again and right-click on it and duplicate that tab. Check our dates over on the balance sheet, which I think is going to be correct because Sage is doing a great job of saving our dates as we go back and forth here. It's not taking me back to the current day, but sticking with the dates that we had put in last time, and I like that. So then we're going to go back to the first tab. We're going to then go to the banking information, and we're looking at those the bank feed stuff that we've been dealing with multiple times here. We have 6 of them left. We're going to go into those 6 and add those to our financial statements. So remember that most of the time when money's coming out, it's going to be for something standard like we did with the first transaction, usually, like the telephone bill or the utilities, and we'll be able to assign those out, and Sage will typically remember them. If we see money going out that's basically a draw, such as this, meaning the owner just took money out of the company, we don't know what it was for. It was just cash that was removed from the company. Now, just want to discuss how we want to deal with that in general. Generally, we would like it to be the case where if money's coming out of the company, it's only coming out of the company if it's just cash coming out of the company. Let's jump over to our balance sheet to look at this. We would like it to be the owners taking money out of the company because we would expect the company's making money, and then whenever cash comes out with just cash going out, we would expect that it would be going to the owner, in which case the checking account would go down and the other side would go to equity. And that would be the case, and that would mean that it would not affect the income statement. That's what we would typically think if money was taken out. Now, if you're in a system where you're an accounting system where you have there's a habit of taking money out and then spending that money on business-related items, then that becomes more confusing because, of course, those items would be expenses over here on the income statement. And the problem is that obviously when we have that transaction for any expense, well, the bottom line is this: any expense that we want to have, we would like to write it off for taxes, and therefore we want to have an audit trail as much as possible. So any type of expense that we have that's legitimate, a legitimate business expense that we can write off for taxes, we would like to make that payment with a credit card or a check or something like that, so that we can track it easily to the financial statements. Cash is more difficult to track. And we want to track it so that if there's questions about it on like a tax return, then we can draw it back into and we can see the audit trail for it. Now, if cash goes out, then it becomes confusing because then we're going to need things to support it, more supporting documentation such as receipts and whatnot, in order to know where it's going. So those are the two sides it can be. So if we see a draw, we would like to set up the system to say, hey, if it's a draw, it must have been the owner took money out. But if you don't have it refined down to that system and you're taking money out and spending it on business-related items, then we're going to have to ask, okay, what are the expense accounts that were spent on so that we can include the proper expense account? And let's just look at the difference, because the reason this is important, obviously, is if it's messed up, then if you're recording expenses for personal items for draws that were taken out, you're not going to be able to support them if you have a problem with deduction of them on the tax return. You won't have the supporting documentation for it. Because, if it's not there, even if it's legitimate, you're going to want the receipts to support that, which is a little bit more cumbersome than simply having a really defined audit trail and you could track the paper trail. So that's going to be the pros. So we're going to start off here as if it was an expense. We took it out and we're going to expense it and see the decrease on the income statement, which will typically result in possibly less taxes if you're thinking of it from a tax perspective. On a financial perspective, it would make you look worse. So remember, those two things are always kind of at odds. If you're trying to look good for financial purposes to get a loan or to get equity financing in the company, then obviously you want to look good. You want to have a lot of revenue and little expenses and your assets to be over your liabilities. If you're paying taxes, then obviously it's all backwards and you want to look terrible and show up with the holes in your pockets and your shoes are worn down and whatnot, and you want your income to be low because then you'd be paying, less taxes. So, right. So it just depends on the perspective you're going to have. So first we're going to, in terms of what you would like, in terms of your revenue, to be paying less taxes or to be looking good in order to approve for something like loan or investments. So let's just think of the situation where money was taken out and then it was spent on something business related first. And then and we don't know which account it should go to. So we're going to put it to basically miscellaneous account. And then in the next month, we'll show the other method or the difference if we can say it was a draw, and then we'll put it to the balance sheet for a draw. So I'm going to go back over here and I'm going to say, all right, we asked, the owner, is this a business related item? They're going to say it's a business related item, but we don't know where it went. So I could set up a vendor for it, but I don't know who the vendor is in that case. The cash was spent somewhere for something business related. We don't really know what, so we're going to have to put it into miscellaneous. The account down below, I'm just going to type is miscellaneous. So see if we have a miscellaneous expense. I don't see one. So let's see if we can add another one. I'm going to go back over. I'm going to right click on this tab. And we could right click on the tab we're on. Let's right click on the tab we're on. Duplicate it. Let's go on over to that chart of accounts. So we'll practice, picking up and making a new account. I'm going to go to the accounting up top so that we can get to that chart of account, and we're going to add an expense account this time to it. Then we're going to go to the settings in the ribbon. So we're going to go on over to the settings in the ribbon. And then I'm going to go to the chart of accounts. So we'll open up the chart of accounts. Now note it's typically going to be in order. You got assets, liabilities, equity, income, and expense type of accounts. If I go down to the bottom here, we're going to get towards the expenses. Also note that I can have a maximum of 50 records down here. So 50 records is the maximum that we can have. So note we have the direct expenses. We've got overhead items. I'm going to then go to the next page here and see what we got on the next page where we have the expenditures. So we've got expenditures. So I'm going to put it at the bottom here. I'm just going to put it at the 7410. It's going to be the number 7410, 7410, 7410. I'm going to put here then the 7410. And then I'm just going to call it miscellaneous. And I'm going to abbreviate it, which may not be I'm going to abbreviate it here. There we got it. And then the category, I'm going to put it into the direct expense. It looks like they're categorizing them in the overhead, the chart of accounts that I'm using here, and it's based on the industry that we have. So I'm going to keep with that convention. We've got the expenses and the other payment. So I'm going to say save. And then there it is. There's the 7410. So now let's go back into the first tab, see if we can pick that up and what it will look like. I'm going to put in here, I could put in the number 7410. So there's the miscellaneous, and there we have it. And I'm going to put it in as a electronic here. So not a check, but electronic. And then what's this going to do when we record it? Decrease the checking account and increase an expense, that being miscellaneous expense, which will decrease the net income. Let's go ahead and create it and check it out. So we're going to create by hitting the little create button. Apparently I had the number, but I hadn't actually clicked on the account, so I did that again. Then I'm going to create it again and see what happens, see if it picks it up. It does so. Then I'm going to check it out by going to the balance sheet, and then we're going to recalculate that balance sheet. And once recalculated, we'll go into the checking account to check out the checking account. So there it is. There's that decrease as expected. So that looks good. I'm going to go on back. And then the other side is going to be on the income statement, or the P&L, otherwise known as the profit and loss. So we're going to go over there and we're going to calculate it. And we should see a category now under the expenses for miscellaneous. There it is. And so there's that item. Now note, we don't have any income yet because we haven't recorded the deposit side of things. And if you're using a cash basis system, we would have the income. Also note, and we'll see that when we record the deposits then. And also note that this, of course, increased the expense, which would decrease net income. If it was a draw, then it would be on the balance sheet. And that's what we'll do in the second month. If it was a draw, it would be down here somewhere in the equity section. And it wouldn't affect the income statement. It would not be decreasing the income statement. So that's going to be it for now. Let's get out of here.